Gentlemen, thank you so much for your time today. Bismarck, let's start with you and just get your perspective on the key considerations for the MPC today and the likely outcome.
I think the growth trajectory of the Q2 growth is very, very important. What sectors that are interest rate sensitive and what's the dynamics of those sectors, one. Two, very important is the fact that the US Fed has cut rates but with no guidance. Thirdly, we'll be looking at the level of credit growth to the private sector and whether the signaling effect of the last two meetings has had any impact. So when that is done, then one can easily begin to take a position. But the jury is out. And
but what are your expectations?
Expectations?
They will hold everything unchanged?
No. 55% probability that things remain unchanged. 45% probability that there will be a cut of 25 basis points.
So relatively close call for you?
Very close call, but definitely I won't be surprised if there's a signaling cut by 25 basis points.
All because of that growth story that you just mentioned.
Growth story and the budget. If you look at the budget, the MTEF, that is the medium-term framework, which talks about debt. And any reduction, slight reduction as it may be, in interest rates which is benchmarked against all state and federal government instruments, that could help reduce the debt burden. But this counter of that is that it could also begin to spur inflation. Inflation has gone down for 3 months consecutively, and so that story is there. But on the other side, you have the reserves that have declined somewhat, and the fact that high-powered money could lead to some other problems. So that's why I said 55 remain, 45 cut.
Tiloba, he just mentioned that the inflation story really is one that perhaps will not concern the MPC that much because it does appear that inflation seems to be relatively well checked at the moment. But what other factors do you think could be big issues for the MPC to consider today?
Well, first of all, let's take a look at where we are. And the reality is that the trajectory on growth is negative, it's going downwards.
I think I recall you mentioning that you actually think we could see a recession.
Yes.
But I don't know if you've reviewed your thoughts on that.
Well, and I think the central bank governor warned on this. It's now a question of what kind of stimulus are we doing. But clearly, the trajectory is that we're heading in that direction. Last year, we saw the economy pick up from about 1.8% growth, and by January, we got to about 2.38%. Now, since we got to that peak of 2.38%, from January, it's been downhill. And right now, we've come down from about 2.38 back to about 1.9, 1.8. So we're now going back to the same levels where we were last year. So for me, the focus for me has always been on growth. And my issue is the fact that if you're not growing this economy, then what impact do we have on the lives of Nigerians? The president himself, I think, said this in his inauguration speech, that he's trying to lift 100 million Nigerians out of poverty. And we need to understand exactly where the focus is. Because for me, monetary policy now is unfortunately very isolated. And it's not connecting with the rest of the economy. And you can see that while you are doing all these changes, the growth has not really been where we need it to be. And inflation, for me, I think we focus too much and for too long on trying to control inflation. Because I looked at my 10-year charts here, and you're seeing a situation whereby the highest growth we've recorded in the last 10 years is 8.5%. Inflation rate at that point in time was 11%. So with 11% inflation, we've been able to achieve 8.5% growth rate. So it's important, and I think that is one of the challenges I think Bismarck has now with the Advisory Council in terms of how they can get a more connective, a more coordination of this whole economy between monetary policy, fiscal policy, investment policy, and trade policy. It is that harmonization and synchronization I would like to see. Because monetary policy is already isolated for the last 2 years, and we're not seeing the impact it's making on growth. So we need to reverse that trend. Is he going to drop the rates? I think it's more than time to drop rates. I think that we should see I mean, for me, I would like to see rate cuts down to about 11% easily.
But the big question always is that if we did see that rate cut, many people mention the unintended, if you like, consequences of declining rates, the pressure on the currency and so forth. But do you really think that a rate cut will spur that growth? Do you think that there's an automatic impact of rate growth, growth due to a rate cut?
Yes, and I think if we take a look at this real sector funding that banks are doing now, a friend of mine went online with one of the banks and actually applied for a facility, and because of his credit rating and those online assessments, he got funds, 5 million naira into his account.
No, it's a new day, clearly.
You see, so
things have changed, especially for consumer credit.
Exactly. So you're seeing that whole stimulus being created. So right now what we need to work on is how to make these rates manageable. But of course, the fear for the central bank is really the exchange rates, and to see, because what you're seeing now is that we're seeing exodus. In terms of capital inflows, we're losing we're hemorrhaging in that area. And one of the ways they would like to see to stem those flows would be to increase rates and to maybe get treasury bills back to the era of maybe when it was 18% and we had high flows. So there's still going to be that conflict. So, but judging from what I see and the trend of this central bank and where they're going, while what I would prefer would be a rate cut, in reality, what I'm going to see is the fact that I will predict that they're going to leave rates unchanged.
Right. I know you want to chime in, Bismarck, but I want to go to Roy in Johannesburg. And Roy, he just talked about Nigeria potentially hemorrhaging in terms of the foreign investment flows. Now, the data I am reading suggests that, yes, we did see that in July, but things have changed a little bit since, and in August we saw perhaps an improvement in those flows, and maybe they are relatively consistent now, even though they're not close to the highs we saw earlier in the year. But the question I would like to ask you is whether or not any changes in the MPC decision today could have any bearing on how foreign investors are looking at Nigeria as an investment destination, especially portfolio investors.
I think that what we saw during the month of August was quite a sharp uptick in the T-bill rates, and we saw a lot of demand coming back in from offshore. We believe that a rate cut now would see a drop in the yield rates, and the concern for the central bank would be the drop in rates less attractive for offshore. And in addition to that, we probably see some capital outflow as we see some profit taken on some of those positions. So we believe a rate cut at this point wouldn't be beneficial for the markets. You know, are we focusing a little bit more? And I know that the growth is a concern, but we focus a little bit more around the FDI and the sort of offshore investment into Nigeria. And I think the benefits of that might outweigh the slight downturn we've seen in growth in Nigeria. On a global picture, the growth isn't that bad, and so we're less focused on that. We're not going to predict any rate cut. We're going to go unchanged. We think that there's a lot more stability in the market. A rate cut would see an outflow of foreign investment, a lack of investment into the country, and from that, we'd be a lot more concerned around the impact that would have on the reserves for Nigeria, on the exchange rate for Nigeria, and the negativity of a weaker naira and the inflationary impact that would cause in Nigeria, we think is more of a focus point for us. So we're gonna go with no rate cut. I know that Bismarck's at 55-45, so kind of on the fence and leaning a little bit towards unchanged. But I think we're gonna go with our view. When I've spoken to the team that is based in Lagos, and I've spoken to the trading team in SA, and again to our research team, everybody from all three teams is going unchanged from the MPC.
All right, Bismarck, you wanted to react to some of the points made?
The point is that a drop of 25 basis points takes you back to where you were before the Fed dropped the rate by 25 basis points. The inflation interest rate differential, our inflation has come down, US inflation has been static. So the foreign portfolio investors are getting a 25 basis cut, brings them back to where they were the day before yesterday.
So I guess the argument you're making is that they won't be scared by 25 basis points.
No, because 25 basis points will be
cut.
actually bring you to equilibrium.
It's pretty much where you were
Where you
before.
were, because the Fed has come down by 25 basis points. The US rates have come down.
In terms of the options?
Yes, European Central Bank has brought down rates. There's quantitative easing. So I do not see that as a threat. In fact, it's a static move. Now, taking all the other things into consideration, inflation has actually come down here while it's there. So the inflation interest rate differential plays in favor of a cut. I think we have to consider that.
Right.
Okay.
Well, when I really reflect on how the markets work in Nigeria, especially the treasury bill markets, the OMO bills, and what the central bank does with its open market operations, I do get the impression that whatever the MCC does by either 50 basis points or 25 basis points cut, it's more of a signal as opposed to really impacting what happens in the market. Because if we take a look at the last 2 months, rates have actually gone back up in terms of OMO rates and so forth.
Yeah, because the maturities are now.
Right.
But in the meantime, the alternatives in the US and Europe have actually seen rates come down. So even if I stay where I am, right, that's an improvement in the yield. There's a yield pickup. And even if I come down by the same amount by which the US and the European rates have gone down, you know, that's the meaning of status quo. Because I'm coming down just as much as the others have come down, and you're getting the same yield because the alternatives are not changed.
Right. There's a point I think we should talk about before we go to Abuja. I want to hear your thoughts on what we're seeing, and I think Tilua alluded to this point, that some of the moves by the central bank and the bankers committee to get a lot more lending happening does appear to be yielding some fruit. I was wondering to what extent you think this could have a bearing on growth.
Well, I
Or is
think
it too
that
early to say?
no, lower interest rates and an increase in aggregate credit
Yes.
is a necessary condition for growth, but it's not sufficient. There are other things that go into it, right? So that's one. And more importantly is that they are not doing that because of MPR. They are doing it because of the loan-to-deposit ratio, which means the penalty of not getting the 60% loan-to-deposit ratio means that they will take all that money out at zero return.
Yes, but of course that speaks to what the central bank wants, which
To
is
do,
more,
yes,
more
which is
credit.
but that credit does not necessarily, there's no one-on-one relationship between an increase in credit and an increase in growth. Because if you look at the growth sectors that actually contracted, they are the ones that are interest rate sensitive, one, and they employ a lot of people, and those are the sectors that benefited from the intervention. So it may not be because of interest costs that we are seeing contraction. It could be because of other reasons. So I think it's not a binary choice. It's a choice of a cocktail of instruments and the impact it has on people.
But Tilua, do you like it?
No, you see, we cannot divulge this from the growth of the economy. We cannot, we're financial market centric, that's fine. But the impact of that cut also we need to see it go into the stimulus we need to create growth in this economy. We're at 35% unemployment. We have the security issues are still quite challenging in Nigeria today. So there's social infrastructure that needs to be satisfied. And it's important that we grow this economy, but at the end of the day, we're also looking at a trade-off between, are you going to create the stimulus to grow your economy, or you want to maintain financial stability? And I think that has been the dilemma of the central bank. And I think what is important is that when Bismarck's Economic Advisory Council takes off, the challenge they're facing is exactly this. They have to address that dilemma. And what we need to do is we need to see some restructuring of the economy. We need to see how we're going to restructure this economy. The fiscal challenges are still there. We have $80 billion worth of debt, 70%, 65% of our revenues going to service debt. And we have to start taking a look at innovative ways to raise revenues. Maybe we need to start selling down on a lot of our JV assets that we have to be able to look at alternative ways of raising revenue. We're going again now for another $2.5 billion at the World Bank. That is concessionary financing, and of course that will be challenged to proper use. But it is important that we restructure this economy to be able to focus on creating growth. Because right now, at 1.9% growth, 3.5% population, we've lost 170 billion of our GDP already. So there are serious challenges
Right.
that we need to address in that area.
But Roy, if you can just speak to this point. Tiliwa just mentioned that Nigeria is looking to the World Bank again to borrow. Yes, he did mention that it's concessionary at a concessionary rate. But what is your perspective on the approach to the economy now? Many will say, thankfully, we've got an Economic Advisory Council being announced by the presidency, and many are expecting that that council will provide a lot more advisory support for the government. But overall, what's your thought on the current approach of the government to trying to drive the economy forward?
So I think it's, I've spoken often about Eurobond issuances and the borrowing of hard currency loans. Now, they can work if they put to good use. So if we're going to borrow dollars and put that into an infrastructure that's dollar generating, then we're going to have dollar income to service a dollar debt. Then things are going to work fine. I think to borrow the dollars is a great idea, and at the concessionary rate even better. It's where that money is going to be spent. I think there's infrastructure spend that needs to happen. I think the creation then of jobs around that point. And that's why we don't feel, and apologies to disagree with Bismarck, but we don't think that a 25 basis point cut does anything to the economy. It doesn't spur growth. It makes borrowing slightly cheaper. I think I recall from our last MPC discussions, there was talks around the government establishing a microfinancing bank to support the informal sector businesses. I wonder how well that has proceeded. Is that happening? The concern also for us from a bank point of view is that we don't want to be forced into lending at suboptimal rates that then leads to non-performing loans. I mean, that doesn't speak well to the economy either. I think I think the important part made by Tiliwa was to say that the financial stability of the market, I think it looks fantastic. When we look at the rest of sub-Saharan Africa, the performing economy for us is Nigeria. And part of that is the financial stability we've seen in the market. The currency is stable, rates are stable, there's volatility limited in the T-bill market that's attractive to the offshore investor. They're coming to the T-bill markets at the right point, they're seeing a bit of a rally, there's a bit of profit for them as well in the markets. I think all those factors are contributing to I think a really good financial market setup for Nigeria. I don't believe at a 25 basis points is going to impact the market too much, other than the sort of intent that message then sends out. Is that the message to send out, that there'll be further rate cuts? Could we expect another 25 or 50 basis points further down the line? And the impact that then has on FDI coming into Nigeria. Right. We see the profit taking, guys get out, the trend for lower rates, maybe they don't want to